Today, we're going to give you my personal portfolio of the top 8 monthly ETF funds that I hold with no Nav Erosion, how well they've done in 2025, and give you our forecast for 2026. Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. And that's right, our top 8. I'm giving you my top 8 ETFs that I personally hold in my monthly portfolio to generate income and a little bit of growth. And this year, as we're ending the 2025 year, we've had some good changes and we've had some good growth. So we're going to cover all that today and hopefully get you better prepared for 2026. Now, I got to put a shout out to all of our YouTube subscribers. Man, if you're not part of the family, if you're not part of the member of the group, don't be afraid to hit that subscribe button. If you like the video we're giving you, give me a thumbs up. And also, don't be afraid. Always hit that bell notification so you don't miss a single video. I got to do a shout out to all of our Patreon guys. Thank you so much for supporting this channel. You guys have been amazing. And we're trying to give you even more information down the road. And all of our YouTube members, thank you for your support. Guys, all we're doing, trying to give you the information to help you grow your portfolio. So let's get into today's video of the top 8 of my own personal ETF and see if it can help you in your challenge in today's world. So the core investment strategy that I personally use is I want monthly income goal. So when I put the money into the portfolio, I set up a goal that I really want. I need to generate that potential of that consistent monthly cash flow because I'm going to live off a majority of this money. The primary focus is on retirement planning. So these are really things that I buy and hold. I save forever. About every 6 months, I do look at it to reevaluate, to rebalance if I need to. But that's the kind of the asset strategy I use. And I'll add positions rather than selling. Unless one is just underperforming, I'll sell it off, add another form into it. But if I take anything, I'll add to my positions. And I really don't want to sell off shares. I want to generate that income. The other thing I look for is, and this has kind of thrown some people for a loop, is when I say my tax efficiency. I'm looking for ROC. I'm looking for return of capital. I'm looking for that deferred taxation until I sell the shares because I have no intentions of selling the shares. So kick that can as far down the road as we possibly can. I want to reduce the cost basis over time. And the beneficiary of having it in a Roth IRA conversion type program is I really want to work with the tax efficiency. Now, the other strategy is I want to prevent the NAV erosion. So I do a heavy studies on the funds, find out what we're going into. We're going into nothing crazy. And I'm really taking a serious look at total return. I'm not just looking at the big, dividend incomes, the big yields. I'm looking for total return because I want to have a balance between income and growth. And then my strategy of diversification, I don't want to put everything in one basket. I don't want to be everything in the S&P 500. I don't want everything in NEOS. I don't want everything in Goldman Sachs. I want to be multifaceted, very diversified to try to reduce my risk as low as I possibly can. The first fund that I use in this process is the NEOS ETF QQQI. Now, NEOS, one thing with NEOS is they actively manage the funds and they're designed almost like what I've asked for. They generate high monthly income through covered call options, but they use the return of capital. They use the 1256 orders, so it helps cut down on the taxes side of things. And here's what QQQI has done for me this past year. We got a 13.98% distribution rate. We had a 3.79% growth year to date. Now, I know we only have maybe a week left from when I'm filming this. Realistically, probably only a couple days, to be honest with you. Can't realize time's flying. So when I close it all out at the end of the year, we'll probably be close to these numbers. So this stuff is just exactly numbers from snapshotting it from when I'm making the video. Now, the thing with QQQI, look at the assets, $7.55 billion under assets. So I don't have to really worry much about the liquidation of a fund. Expense report is only 0.68%, pays at 13, says here, the dividend's down 13.7, so I'm a little bit higher than what we originally had. And then I look at this. You always look at a fund when you can say over 1 year, what's happened? Well, we had the tariff times, April 2nd, it dropped off. We had a little market adjustment in November, but it's recovered completely very well. So I look at the long-term performance. Since inception, when you add in distributions and growth, you're over 20% on the QQQI. 1 year, 18.1, and year to date, 19.77. So across the board, I'm very, very comfortable with QQI, and it's in the NASDAQ 100 high income side of it. Now, I do stick with NEOS because of, again, the covered call side of it, the tax side of it, and this one uses the S&P 500. Now, I only put 10% of my portfolio into this one, and you will see I'm maxed out. I will never go more than 15% in any particular fund. In any, that's the largest I'll put into it. So 15% into the NEOS QQQI, 10% into SPYI. And I'll explain that in a minute, why only 10% here. This one has the 11.62 distribution, had a 3.99% growth over the past 12, basically year to month, I'll say 12 months. Now it's designed as S&P 500. I look at the S&P 500 was up 18.49%, I believe it was, for the year. So I collected 11.62% in distributions plus 3.99. So, I got 15 out of 18. So I got the income I was looking for. The 0.68 expense ratio, it means the majority of my money is going to work for it. And this one here, we take a look again. Since inception, 14.8. 1 year, 15.71, and year to date, 17.37. So it's really doing everything that I've asked for in a total package with the taxes and everything else involved. Now, this is the only area that I'll tell you is where I double dip, and this is why I have 10% in NEOS and I have 15% in TAP Alpha. TSPY is almost the stepchild or very close to NEOS's SPYI. But TSPY is the S&P 500 for growth and daily income. Now the distribution is a little bit higher. We gained about 2 percentage points. But remember, I'm not always dialed into just what the distribution is. I'm looking at distribution rate plus the growth of it to give me a total return number. So this one here, again, uses all the same type tax efficiency sides of things. Expense ratio, we're up to 0.77 versus 0.68. So not a big change between the two. $164 million in assets, 6.48 million shares outstanding. But what I really liked about the TAP Alpha side of it was look at the numbers and the performance. Since inception, 18.25. 1 year, 16.04, and year to date, 18.12. So it gave me more income than growth. But between the two funds, I think I got the S&P 500 almost covered every which way possible. Then I turned 10% of my portfolio went into KQQQ. This is the technology titan from Curve. Now this one really focuses on tech stocks. And it's all the big names of tech. This is the big thing people get confused with is KQQQ is a technology titan, but they also, a big chunk of their portion is done with only a few handfuls, which is NVIDIA and Google and Apple. And so they're really dialed into that. So they have other areas that they do things with. So again, this one comes in at 3.93% year-to-date growth, 11.91% distribution rate. The expense ratio gets up there 0.99. Now, all these numbers I give you, are including the expense report. So, I could say the expense is 2%. The numbers would be the numbers after a 2% deal. But 0.99 expense ratio is very common in this type of fund. I'm not real excited about it. I like the lower fees onto it, but really looking at it, a tenth of a point difference between funds, as long as they're producing the distribution and the returns, I'm okay and pleased with it. Now we look at this one at $83 million in their assets, 2.93 million shares. So it's one of these things I can really trust and not have to worry too much about. The inception rate, 20.8%. 1 year, 15.54. Year to date, 17.68%. So again, long-term track history. Now I know a lot of these may only be 1 year old and maybe pushing their second year as we get into the end of 25. But realistically, I'm looking at these are the new guys on the town that are doing well, and you got to study the charts. The April 2nd drop off, it recovered fairly quickly and came back and still growing. My next fund is Amplify QDVO. Now this one gets into the Russell 100 growth index. 10% of my portfolio goes into this one. Now the distributions are down 9.88%. So you question, well, why would you even be interested in this? Because you cannot always just have income. You need income and growth. And so I felt like balancing this thing to getting almost a 9% in growth side of it and a 9.88% in distribution side of it. And I'm also dealing into the Russell 1000. So it's kind of a happy medium. I don't have Russell in any of my funds other than this one. I have income and growth, and I have an expense ratio of 0.55%. And it still uses that return of capital, and it uses the tax efficiencies across the board. I looked at the long-term performance again, 22% since inception, 17 over 1 year, 19 over a year to date. So I'm very pleased with the numbers I get out of QDVO. Now this one will throw some people for a loop, but I still am into the yield max. I got the big Y. Now I'm only 10% into the portfolio, but here's the thing that they have. This is their targeted 12 big 50 option income. Now, what does that all mean? Well, they're targeting a 12%, so it's their target. It's not guaranteed. None of these distributions are guaranteed. But what it is, it's targeting, trying to achieve a 12% income return. So when I've done my research on this one, and before I even jumped into it, I wanted to really give some history into this. And I bought it at early times, which is probably a no-no for me across the board. I always have a review of you got to be 3 to 6 months old before I'll even start looking at it to evaluate, is this a good fund or a bad fund? Well, the whole Target 12 was so interesting to me that I said, I just have to, I got to try it. I got to gamble and do it. And actually, I'm happy because it kind of turned out to be a good response for me across the board. It had the 6.05% total return year to date. We have about 11.31% return in the yield. So it almost hit that target mark at 11.3. But I did not expect the 6.05% growth that I expected to get out of it. So the expense ratio was a little bit high, which is why I relate to the dividend side of it being down. They're charging 1.09%. So it's a thorn in my side with yield maxes. You're charging a very high expense ratio. You didn't achieve your target. I don't want to downsize yield max because they do have some good products. They do have some good managers in there, and other managers are terrible. So I know I'll get a lot of reviews, a lot of comments about how bad yield max is, but for me, it's actually done well with this target 12. So again, we look at the overall rating, 17.62 since inception, 17.96 over that 1 year, and year to date, 19.78. So it's really been able to produce both income and growth on my side of the fence. Now this one here, I will tell you what, I look like a hero putting this one on the screen. But if you would have talked to me in mid-April, May, I was one of the guys ready to just bail ship, jump off and say, I'm done. I picked the wrong fund. And this one comes into the curve GOOP. Now, everyone always thinks because it's in the name, this is a yield premium strategy for Google. Well, they're not just 100% in Google. What they're in is they're doing a synthetic covered call strategy over communication services. Now, Google's been a big part of theirs, but it's more of the communication services across the board. If you do your research, as I suggest everybody do your research deeply into this, and you'll find out how much of it is into communication versus just Google. So the big help that it had is Google did take off for them. They did had Google was down like 20%, as I said, in April and May, and it's up over 106% over for the rest of the year. So this thing came in at 30.16% year-to-date growth. Ended up with 11.78 distribution rate. Expense rate 0.99. I understood that with the synthetic cover calls. That's going to cost some money. But it was really impressive. And when I take a look at your numbers now, since inception, 42% since inception, 51% over 1 year, and year to date 52. I've been very pleased with the performance of Curve and the GOOP portfolio. I have 15% into it. And again, I'll tell you, in May, kicking myself. Why did I go 15? I should sell off, get out of it, do what it is. And something just kind of doing more research told me just hold tight for a little bit. And now I wish I could have a bigger number, a 30% or something like that, because it's greed talking, because it's done so well for the portfolio. And then I also use this one. And this one again, I've done this a couple of videos on this one, the SLVO, which is USBS E-Trax Silver Share Covered Call. We have 15% of this. I did a lot of research. I did a lot of different things into it and found that silver was going to, and seemed like it was going to have a chance to have a run. And has it run? 38% growth already year to date. Also, I got a huge dividend out of that, 19.19%. So it really works in the silver commodities. The expense ratio was low at 0.65. I was pleased with the performance of it. And when you look at this thing, this is not a fund that just opened up. This has been out there for a long period of time. Inception 3.98 or 3.93%. I wasn't excited about it. But when I looked at the 10-year, I'm getting 10%. I'm getting 5-year 14%, and then we're getting 69 and 72% 1 year and year to date. I said, even if I look this thing out 10 years out, I'm getting a 10% return. I can't beat that pretty much. It's almost like a locked in number. So I'm like, let's try this. And I've been pleased all the way through with this system and this setup right now. So when we take a look at the performance analysis, the distribution versus total return, and that's the one thing I always want to say. I did not put that in every one of the slides, but was the total returns that I was dealing with. So I put this in a spreadsheet for you and show you some charts onto it. And the total portfolio is I focus on total returns. So you see the silver one is almost up to 57, 58%. And the blue is my growth, and the yellow or the brown is the income. So you see my incomes are fairly balanced across the board, all breaking over that, basically that 10% mark. I think the only one that doesn't is QDVO. Everything else gets above that 10% mark, which is what I really had targeted for originally. But when I take a look at the growth factor, I was pleased that every one of them had a positive growth. Now, GOP and SLVO were huge growths, which was great pieces to have in the portfolio. But when I take a look at those total returns, every one of them gets to that 15%, almost pushing to the 20% category across the board. So to me, I feel like I did exactly what my goal was, is to have a balance. So I have a balance is key. I have a NASDAQ 100. I have 2 S&P 500s, but everything else has a reason for it. Silver, communications, the top 50 and the big Y. And then we get into tech across the board. And I've been able to keep the capital erosion risk away. I've been able to manage that. Now, this one here is my year-to-date performance. And we started off with $500,000 into my monthly portfolio. So this is just where I put monthly ETFs. I break my portfolio down to high yield, which is about 5%. I get into the monthlies, and then I get into my weeklies, and then I get into just my long-term across the board holds. So the monthlies is the one I'm looking at across the board with a $500,000 starting value into it. We had a growth of 13.53% or $67,000. My income was $66,000 or for around 13.24%. So my total return was 26.78% with a total return of $133,910. Now, after that, you got to also take in that income I'm using to live off of. I have to take that money to pay out everything that we do to live off of. So the fund really only came into with the growth. So it got to $567,665 or 13.53%. But I started asking different people who follow the channel, and we get to talk quite a bit on this. Why do you go after the big, huge yields to have the high risk? And it's because people need the income to live off of because they don't have the big starting number up front. And that's the positive thing that happens when you have a little bigger starting value is you're going to get growth. If you do it properly, you'll get growth. You'll continue to grow your funds, and you still have money to come off of and to live off of. So it really came into me. I ended up with almost literally a 50-50 mix between growth and income. So it wasn't designed that way. It was more designed for a 70-30 mix. And I actually came in with a 50-50 mix. So growth was bigger than the income, but the income was about what we were expecting to get. So in conclusion, the strategy that I used worked. And it really gave me everything I'm asking for. It gave me the monthly income. I've had very good. We'll see how it goes because we'll see where the tax efficiency comes into because my tax guy, my CPA will run everything for me. And hopefully we'll have a positive tax efficiency with the return of capital. The Nav prevention, we stopped that one. We did not have that. And we had the strategy diversification, a very well thought out across the board. So I'm hoping that this actually can help you down the road to how you build a portfolio to live off of dividends. I'm showing you live what I do, how I have it. I'm not afraid to share that. So I know a lot of you have asked for it. So give me a comment down below. What do you think? Is this a portfolio you think works? Does for me, but tell me what you think, where you're at with it. And do you like the funds or you have something that's even better out there? I'd love to hear from you because I'll be rebalancing this in January to make a look forward to what 2026 will give us.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.